And welcome everyone. Still 10 minutes before Q1, so there's still about 10 minutes for everyone to start joining. Thanks for being prompt and early. We'll start at 1 and do an introduction, wait for everyone to join. All right, in the meantime, hope you got your coffee or something cold to drink, and we'll talk in 10 minutes. Hey everyone, it's 5 to 1. Still got about 5 more minutes before we can start. Hope you're all ready and you can hear us correctly. Um, and did everyone get the notes?
Hi, everybody. We're approaching 1 o'clock. There's still a number who haven't joined us. We'll just let it run over a few minutes just to make sure that everybody joins us. Otherwise, Jackie will have to repeat everything. So we'll just wait a couple of minutes and then we'll join you again. Thanks. Danny, shall we give it another minute?
Well, I think so. Let's start with your introduction, and then we can let people catch up because we're over halfway there with people joining in. So let's get it started
Okay, great.
because
Okay, so welcome everyone, as I said before, and I'll say again, and thank you for joining us. I guess it beats working. And thanks, Jackie. Always interesting to have you and always a pleasure to have you. Just regarding the budget, as my friend Enoch told me after the budget speech, he said, it's easy to stick to the budget when you have no money. So, Jackie, I'm going to hand it over to you and take it away. Thanks.
Great. Thank you so much. Thanks, Dan.
We will stop at about halfway, right?
Yeah, so I'm planning to go for about 1 o'clock, let's say until 2:30. Yeah?
Yeah, perfect.
And then we'll take a 15-minute leg stretch and then we'll go through to the end. Yeah. Does that sound all right?
Okay, good. Yep, sounds wonderful.
Okay,
thanks.
Great.
Bye.
Right, well, hello everybody, and thank you for joining us this afternoon. It's wonderful to have you online, and I'm going to be talking about the 2024 budget speech. So as we have just arranged, we will take a leg stretch, coffee break, tea break, whatever kind of break you want at 2:30, and that'll be a 15-minute break. All right, and then after that, we'll run through and we're due to finish at 4 o'clock. So we'll finish somewhere between, say, 3:45 and 4, somewhere around there. Okay, so we're going to be talking about the 2024 budget speech. And of course, the budget speech was presented this year. It actually took place fairly early. It was presented on the 21st of February. I was kind of wondering if they were going to postpone it. I remember, I think it was last year, it ended up being postponed. But it did indeed take place on the 21st of February, and in an interesting context, because of course, we cannot forget that this year is an election year, and the budget speech is presented by the government, who's obviously affected by thoughts around the electorate and thoughts around the election. But of course, it's not just as simple as that. It's not just an election year. It's also a budget speech that is presented in a very challenging context. And so before we get into the tax proposals, I'm going to just go through some of the economic numbers that provide the context for the budget speech. And it helps us to perhaps understand a little bit more of the broader issues underpinning the decisions that were made around the budget speech. Now, as I'm going along, if you have any comments or questions, you're welcome to pop them into the chat box, and I will try and pick them up as we go. If it's getting rather busy and distracting, then we'll leave them until the break. I'll pick up some more just after the break. And then, of course, we'll also pick up any last remaining questions at the end of the webinar. All right, so if you do have any questions, please pop them into the chat box and we'll pick them up. All right, so if I look at the sort of economic context in which the budget was presented, now, of course, if we had a snapshot of the budget in essence is, from a government's perspective, how much money are we going to get in and how much money is going to go out? And what are we left with? So if we look at our revenue and expenditure, we see what's coming in, what's going out. And as we have seen year on year on year, we end up with a budget deficit, that our spending is higher than our revenue. And of course, this has been the case since around 2009, where it's sort of an isolated instance where we actually had a budget surplus, and that was around about 2008, 2009. And ever since then, we've had budget deficits every year. And in itself, having a budget deficit is not really the concern, but I think the real concern is the magnitude of that budget deficit and what it's doing in terms of compounding the levels of government debt. So, I mean, if we end up with a budget deficit year on year on year, and we are not seeing massive debt repayments happening, what we're seeing is that government debt is then escalating. And we'll have a look at some debt numbers on the next slide. But when we look at this budget balance, if we look at the revenue, And so this second column is 22-23. That's obviously for the government fiscal year running through to the end of March 23. And now that we're a year down the line, we could call that actual. All right, that's what we've come out with. Now we're in the current year running through to the end of March 2024. That's this kind of middle column. And so what we have here is a revised estimate. So obviously there was an estimate put together in the 2023 budget speech that was revised at the time of the medium-term budget speech back in October. And now we have the revised estimate, the sort of second revision, as it were, at this point. And then, of course, the last column is looking forward. And this is what is kind of new territory now in terms of what's come out of the budget speech. What do we expect to happen in the next fiscal year? Now, if you look at your revenue, it's kind of approaching and then next year exceeding 2 trillion rand. So this is in rand billions, but if we round it off, 1.9 trillion last year, 1.9 trillion this year, just over 2 trillion next year in terms of revenue. And with expenditure, of course, we can see that escalating year on year. Now, if we look at the expenditure as a percentage of GDP, that's what these italicized numbers are here, the percentages. So our revenue, see 28, 27, 27, expenditure 32, 32, 32. So, I mean, there immediately one can see the problem that expenditure is way in excess of revenue, giving our budget deficit sort of hovering around 4 or 5% of GDP. But of course, that accumulates, as I say, over a period of time when you have budget deficits year on year on year, and you don't have sort of a mechanism of repaying this debt. What is also key in the budget overview is the growth of the economy or lack thereof. So if we look at the GDP growth last year, 0.6%. This year, they're expecting 1.3, although we've just seen a very conservative or dismal report on economic growth coming out year on year up to the last month or so. And it was looking, I think, at about 0.1% or something in the last quarter. So it looks as if that number could be a little optimistic. And if we look forward to next year, from what I've heard in terms of feedback from various economists, it would seem that 1.6% expected growth is also rather optimistic. I've heard many economists are saying they don't see it reaching even 1% in the next year. Remember, this is real growth, okay? This is stripping out any inflation. So if we look at inflation, it comes in on the next line, and that we at least see has been coming down slightly. So 6% last year, 4.9% is the expectation for this year, and then 4.6% is the projection for next year. So if we had to take GDP growth and the actual real growth and inflation together, that's coming at sort of 6.2%. And I identify that now because obviously that's going to flow through to our tax revenue forecasts, etc. All right, so basically not a very pretty picture in terms of the budget deficit there. Also not a very good picture in terms of economic growth. And I mean, really, at the end of the day, if we're looking at our massive unemployment levels, we're looking at government debt increasing year on year to rather alarming proportions. We've seen interest rates going up in the last few years. Okay, sure, we've had a little bit of a break from that. But, you know, the pressure is definitely on as far as households are concerned. And what we are seeing is rising levels of private debt. There's no doubt about that. And of course, I think if we had to take one point out of all of this, it has to be that we really have to find a way of growing this economy. I mean, we cannot be lagging along, stumbling along with growth rates of sort of 0.1 or 0.6%. And I see Ian's raised a comment saying that in a webcast, the finance minister stated that raising the foreign exchange investment limit for financial institutions was a grave error. Yeah. Yes, Ian, I did see that comment, and it seems that what might happen is that government could well look at pulling back on that. I mean, we've seen a lot of reaction in terms of retirement funds, for example, maybe having to move more towards prescribed investments and so on. So yeah, I mean, it is a concern. It looks as if they might become more restrictive in terms of offshore investments, but yeah, we'll have to see what actually carries out from that. It's a little bit of a stormy situation at the moment, because I mean, even if you look at what was in this year's budget speech, and then barely a few days later, the ANC released their election manifesto. And from what I've seen, what they said in the election manifesto was very different to what was said in the budget speech. And then, of course, you have these comments coming from the Minister of Finance. So there's just a lot of voices, even within the ruling party, there's a lot of different voices coming through, let alone all the other parties that are out there. But I think what is important, and let me say it now, I don't want to get into a political discussion here, but I think never mind politics. I think what we see with our economy, what we see with the challenges, what we see with the need to grow this economy is that we have to all get out there and vote in May. And we need to vote for a party that can provide the necessary economic management that we need so that we can grow this economy, that we can reduce unemployment, that we can actually start producing some real growth. I think we owe that to our next generations coming after us. All right, so let's then move on to the next one. I want to show you, unfortunately, I can't say let's move on to brighter things, because now we look at government debt. And here, this is rather an alarming picture, because, yeah, every year, if you look at this graph at the bottom, you'll see that's when government debt dropped, sort of went down, down, down to like 2007, 2008, 2009. That's the point I was saying earlier, where we had an actual budget surplus. Now, of course, yes, that was because all around the world, just before that financial crisis hit, things were soaring, big waves of economic movement and so on. And they say a rising tide lifts all boats. And so, we were all benefiting from that. Then we had the 2008 financial crisis. And of course, some people would say that, it took a very long time to recover from that. But certainly from that point, if we look at the government debt at that point, it was sitting at around about 30% of GDP. And then every year that you have this budget deficit, of course, we see it carrying out. There's your debt just climbing up step by step by step by step every year. This wasn't a budget surplus, but somehow they managed to reduce the debt there. But then suddenly, boom, there it jumps up, and it's kind of stayed up at these levels above 70% of GDP over the last sort of 4 years. And it's projected to continue on that trajectory unless we do something quite drastic to rein in this trend. So when we look at the gross debt sitting at about 5 trillion, projected to go up next year to 5.5 trillion rand. I mean, if you get bored during this webinar, maybe one thing you can do to entertain yourself is to actually write out 5.5 trillion rand with all the noughts. And, just to get the magnitude of how large that number actually is. So it is a massive, massive number. And the point is that it keeps growing. And if we look at it in percentage terms, percentage of GDP, sitting at sort of 74% of GDP. So from 30% down here in 2009, 2010, soaring up to 74% of GDP. And George, I agree with you. Growing the economy is absolutely key. And why do I think the government is reluctant to do anything meaningful in this regard? Well, yeah, I think it's a very difficult one to say. I can't speak on behalf of the government, but there must be answers out there. And South Africa has very bright minds, many bright minds, many people capable of incredible initiative. And surely, with the right decisions, the right intentions, the right management, there have to be ways of growing this economy. Now, the thing is that with the government debt going all the way up to 74% of GDP, not only do we face the prospect of how on earth are we ever going to repay this, but the point really is, I mean, us as human beings, we would say, well, you got to repay your debt over your lifetime, etc. You can't leave it for the next generation. Governments don't really have that lifetime perspective. But what they do have, and it's unassailable, is that they have the obligation to service the debt. And so even if you say, well, the debt can keep growing and growing, we never really have to repay it, it's not a problem. The issue is that you do have to service it, and the debt service costs are also becoming rather alarming, especially with the rising interest rates that we've seen. And of course, the Rand has not been too wonderful in terms of its performance as well. So quite a lot of this debt is secured from international sources, and so then you have the exchange rates to worry about as well. So our debt service costs is now becoming the largest expenditure item in the budget. I think it's around about 20 cents in every rand of revenue that is generated goes on debt service costs. And this is only going to become more challenging if we do not get the growth because there's no other way to grow our tax revenue other than through economic growth. It's really not a possibility to try and grow that tax revenue by raising tax rates. I think we realize that we've reached the end of that fiscal cliff. So the only way is to get economic growth, to generate additional tax revenue that way. Of course, managing expenditure, that's a given. We definitely have to see expenditure being managed, but you can't slash that expenditure just suddenly, because about 2/3 of that expenditure, government expenditure, is in the form of salaries and wages for people who work in the government sector. And so, yeah, it all becomes a very delicate balancing act. But the thing is that we have so many imperatives in South Africa, and I really don't think that this is a great situation that we're in, where the biggest expenditure item is debt service costs. You know, I mean, what about housing? What about education? Oh, we could just go on and on about all of the other priorities that we have. And yet here we are having to allocate. Can you imagine what we could do with even half of this amount, 190 billion Rand, if we were able to properly use that with proper management, if we could properly allocate it to something like education, housing, healthcare, primary healthcare, and things like that. So yeah, this rising government debt is a huge concern, and I do think it's something that has to be addressed. But of course, you cannot address it without achieving a growth in the economy. All right, so having put all of that on the table, of course, now we come to tax revenue. So we spoke about government revenue, government expenditure. Let's just hone in on tax revenue and just look at the trends of this tax revenue. Now, I've pulled out these sort of major types of taxes, and then I've got this other taxes down at the bottom here. I know this is a very detailed slide, but it actually tells us a lot of very useful information. So this column over here, 23 outcomes, so what was actually achieved up to the end of March 2023. There's your 1.7 trillion Rand of tax revenue. And you can see, of course, most of it comes from, well, the biggest contributor is personal income tax, then VAT, corporate tax, and so on. There's the fuel levy in fourth place, because we can allocate dividends tax and corporate tax together. Fourth place, fuel levy. Then we get customs duties. Then you get your SIM taxes, specific excise duties, and then these various other things. Now, from the end of March 2023, in the 2023 budget speech presented in February 2023, this is what was projected for the year up to the end of March 24. Okay, that was the original projection. That was revised now when the 2024 budget speech was presented. They've now revised the expectation that for the year that's going to go up to the end of March now. And you'll see that some of these numbers have changed quite significantly compared to what we had in last year's budget speech. So the change over here, I mean, if you look at personal income tax, they projected 640 billion Rand. Now it's gone up closer to 650, so way above what they originally budgeted for in the 2023 budget speech. So it's a 1.5% change, 9.5 billion Rand better than what they budgeted. But then you look at VAT, and it's way down on what they budgeted. Corporate income tax as well, way down on what they budgeted. And so what is going on here? It's very confusing. I mean, we can understand that maybe the commodities boom that they had been so-called surprised by in previous years, which generated a lot of additional corporate taxes, didn't materialize this year. But, certainly they wouldn't have budgeted for a massive commodities boom. So what happened, it's not quite clear, except one does wonder about the accuracy of these budget numbers. If we go down to the fuel levy, this is also a very interesting one. So the fuel levy last year, 80 billion. In the budget, they expected 90 billion, and they came out with 93 billion. So 3 billion rand more than what they budgeted for. And so this 93 billion represents a 16% increase over the previous year. That's a massive amount of additional fuel levy. So, I mean, if you took the fuel levy up to the end of March 23, and you said, okay, let's add on, let's say 5% or 6%, all right? That would take you to about 85 billion, and yet we collected 93. So it's about an extra 8 billion rand of tax revenue that has been generated, and that is because of generators, I would suggest. It's because of all the corporates and households that have had to run generators using diesel and having to pay the whole fuel levy on the diesel. So that is a cost of load shedding basically coming through there. So from the budget up to the revised estimate, an extra 3 billion, but actually, this budget was already quite a optimistic budget in terms of they already expected a big increase, and yet it came out even more than that. So yeah, fuel levy has been a big boom, as it were, for SARS collections during the course of this year. Customs duties, yeah, a little bit down. That's on your imports. Specific excise duties surprisingly down, because that's your sin taxes, and there's not any clear indicator as to why your sin taxes would come out less than what they're budgeted for. Because, as far as I'm aware, we haven't had a major health trend in South Africa where everyone stopped smoking and drinking. So I'm no clear indicator as to why that reduction is there. 5 billion rand less than what they projected last year. And if we look at this year, compared to, what they projected in last year's budget. And if we look at what they collected last year, 55 down to 54, so a slight decrease, 2% down compared to last year. And then the skills development levy, that links with your personal income tax to some extent, but here we see it's actually down a bit. Taxes on property and your other taxes. What I also just want to point out on this slide is, apart from these trends, which just look quite odd, is this indication on the right, which is very interesting, about our reliance on the different types of taxes. So our total tax revenue, 38% of that total tax revenue is drawn from personal income tax, all right, individuals. And it could come through a little bit more if you take into account the payroll taxes and so on. Then you've got VAT at 26%, corporate income tax at 17%, dividends tax, fuel levy, customs duties, and so on. So fuel levy is, still being quite a big contributor there, and your specific excise duties, sort of 3 or 4% over there. But certainly what I want to highlight is the significant reliance on personal income tax. And as we hone in on focus on that a little bit more, what we see is that there's this huge reliance on actually a very small group of taxpayers. And that is one of the big reasons why a change in tax rates, an increase in tax rates, is not going to produce additional tax revenue. Even introducing a new form of wealth tax, in my opinion, will not produce any significant amount of tax revenue. It's just going to create a lot of additional legislation and administration, but it's not going to produce a lot of additional tax revenue, because you've pretty much sucked all the water out of the stone already, and you actually are relying on very, very few or a small group of people to generate a huge amount of tax revenue. And also, when they talk about tax compliance, one of the major contributors to tax compliance is that taxpayers feel that they're getting something for the money that they're paying, that there's some confidence about the taxes that they're paying. And the more we erode that, and the more people lose their confidence and lose their optimism, the more difficult it is to maintain the same levels of compliance. Sure, we have penalties and interest and all those good things, But at the end of the day, you get a much better compliance coming through if people have confidence in the fact that their taxes are going to be well used. So as we look at this breakdown of the tax contribution to this final total, National Treasury also released this little graph over here. Now, this goes back a few years. I'm not quite sure why they put it into this year's budget documentation, but it's quite interesting because it does indicate how this shift has happened, that we are relying more on personal taxes, personal income tax, to some extent even more on VAT, and less on corporate income tax. So this reliance on corporate income tax significantly down, and the reliance on personal income tax and VAT significantly up. So Colin, your point is, isn't SDL ring-fenced towards seated training and not available for general expenditure? Yeah, I mean, that is true. It is supposed to be used for that. So it is not available for general expenditure, yeah, and yet they still include it into the tax revenue numbers. Okay. All right, so just an interesting one there. So then if we look at tax revenue, so we looked at it up until the end of March 24. Now, if we look forward to the next year, and I've just broken it down into slightly fewer groups just to make my slide not quite as dense in terms of numbers, although I think we're all accountants, so you don't mind looking at these complicated spreadsheets, but let's just make it a little bit clearer. So looking forward, so this is the year in the middle here, the year up to the end of March 24, the year that we are in. Gross tax revenue projected to be 1.73 trillion rand, up from last year 1.69 trillion. All right, so that slight increase over there. And then next year, they are projecting, and this is what was announced in this year's budget speech, a 7.6% increase in gross tax revenue. Now, if we just pause and think about that for a moment, 7.6% increase in tax revenue, and yet earlier we said that the projected growth in the economy is 1.6%, and inflation is sitting at around 4.6%. And I made the point that you add that together, comes to 6.2%. And yet here we're looking at gross tax revenue of 7.6% increase over this year. So how are we going to get that additional tax revenue? And if you look down into the various components here, it's indicated that that is really going to come through personal income tax. So we see taxes on income and profits, which is personal and corporate income tax. But of course, most of it is personal income tax. If you look back to this previous slide I showed you over here, personal income tax way outstrips, is kind of like 2 to 1 in terms of how much is personal tax, how much is corporate tax. Okay, so most of this is going to come through personal taxes, and they're looking at an 8.7% increase, which is really quite bold, and quite how they're going to reach that has not really been explained. So we see a little bit of a real growth in the economy, inflation, yes, pushing up salaries, wages, profits, and so on. But 8.7%, I'm not clear as to how they're going to arrive at that, unless there's some plan to grow the tax base, but we don't really see anything coming through there. If we look at domestic taxes on goods and services, this is largely VAT that's coming through here, and they're looking at 6.1. So that's in line with that 6.2 with the growth in the economy plus the inflation rate kind of drives through. That does make sense. Taxes on international trade, about a 5.9% increase over there, and other 6.9. So the big question is, how are we going to get all of this extra tax from our personal income taxpayers? Maybe there'll be a little bit coming through companies. Certainly companies didn't do too well this year, as I showed you on this slide 2 slides back. Corporate income tax down from 345 billion last year to 301 billion this year. So yeah, if there is an expectation that it's going to suddenly bounce back up again, what is going to underpin that? That's not been made very clear. So yeah, just very interesting. And I think that might be quite optimistic in terms of that expected revenue. Now, the next is ratio is interesting. Tax revenue as a percentage of GDP. And this is really the measure that is used to tell us how heavily we are taxed. Are we heavily taxed as a country? Well, 25% certainly is higher than most of our sort of trading partners, if you like. Most of the countries around us and, even internationally, that is quite a high percentage. Yes, you do get countries with higher percentages like Sweden and so on, but that is a whole different ballgame that you're talking about there. And you also look at, what do the governments actually provide for the taxes that people pay. So 25%, we are quite a highly taxed country. And that's why, personally, I think if people start calling for higher tax rates, I think that's misdirected. I don't think it is. I don't think it's terribly justified in this current context, and I don't think it's going to produce a lot of additional revenue. So our GDP is sitting at 7.5 trillion. Now, what is also interesting is the tax buoyancy ratio, and this is one that SARS started reporting on a few years ago. In essence, tax buoyancy is really saying, for a certain amount of growth in the economy, if you grow the economy by a certain percentage, what is the spin-off as far as tax revenue is concerned? So a ratio of 1 to 1 would say, let's just put it very simply, if you grow the economy by 5%, your tax revenue will grow by 5%. So kind of in kilter, it's in line. 1.2 tells us that your tax revenue grew more than your growth in the economy. And so that is quite a good ratio to have. What happened in between is a little unclear, going down to 0.54. That's a very bad ratio. It's telling you that your tax collections are lagging behind your economic growth, but they're expecting to bounce back next year and get up to 1.3. So yeah, just an interesting one there. I think your tax buoyancy, I think that links into what I was saying earlier about motivations for compliance and that sort of thing. You've got a healthy economy, you've got people optimistic, confident, feeling that they're getting value for money with their taxes, then I think you would tend to have a higher tax buoyancy. When you've got people who are just feeling that they're shortchanged and getting angry and having not as much confidence in economic policy, I think that tends to have a negative impact on tax buoyancy. So yeah, I mean, there's a lot of things that come into it, obviously, but I'm just taking a very superficial view there. All right, so just a very interesting one. So going forward next year, this expectation about the 7.6% growth in our gross tax revenue. And I think, looking at that, taking into account the level of government debt and the need to try and get tax revenue as high as possible, I think, what it does also tell us is that SARS collection efforts, I think, are not going to ease off. I think, if anything, we're going to see even greater enthusiasm in terms of trying to collect taxes to try and reach this target that has been set. All right, so if we look at the main tax features against that sort of backdrop of economic statistics, so a very interesting one, because remember at the beginning I made the point that this is an election year. So yes, it's an election year. You've got the challenges around the high levels of debt. You've got the world watching us as a result of having been grey listed, and also looking at how we are managing the finances and so on. We don't want to put out any bold statements that might make people react badly as far as investment and forex rates and that are concerned. And so I think, if you think about the Minister of Finance, the way I see it is that it's a bit like walking on a tightrope, and you just don't want to make any major movements left or right. And so he really stuck to making no movements at all. And so we saw already no changes coming through in terms of your personal tax brackets, your rebates, your medical aid credits. That stays the same. Company tax, dividends tax, other withholding taxes, even jumping down to the bottom, trusts, estate duty, donations tax, transfer duty rates, all of them unchanged. That seems to be the theme of this year's budget, unchanged. But I mean, can we really be, can we stay totally unchanged in this very challenging environment? But yeah, let's leave it there. So a major announcement that we did see coming through in this year's budget speech is this announcement about global minimum tax. Now, that is not something that South Africa has sort of come up with. It's actually in line with international trends. I think there's more than 100 countries around the world that are in the process of introducing global minimum tax, and I'll talk about that in more detail just now. Another quite big announcement for the motor vehicle manufacturing industry is that there's going to be a new incentive for manufacturers of electric and hydrogen powered vehicles. So I guess that's a little bit of yeah, something to fire up a bit of enthusiasm. I'll talk about that later. It's only going to come into account in 2026, though. Again, that word unchanged on fuel taxes and road accident fund levy. But there is a slight increase in the overall fuel levy, which I'll show you on a later slide. It comes through because of the carbon tax levy. Some taxes increase as they do every year. That's why I'm a little baffled as to why our sin tax collections were down, unless we're seeing a major shift towards illicit trade. I don't know, but it wasn't really explained. But nonetheless, our actual rates of sin taxes have increased again. They increased at the time of the budget speech. And then looking at these other stealth taxes, these background taxes that we don't make the headlines and we don't see them sort of all the time, but they certainly affect the price of goods, and we are all paying for these environmental taxes. And basically, there's an increase across the board on environmental taxes, which I'll itemize for you a little bit later on. I spoke about the capital taxes. And then the other important aspect, not so much a budget announcement, but just a development that's happening, is this two-pot retirement system. Now, if you did participate in the year-end webinar that I did last year, you will know that the two-pot retirement system was contained in the Revenue Laws Amendment Bill of 2023. And we went through all of that in a fair amount of detail. The key aspect there was the implementation date. And in the Revenue Laws Amendment Bill of 2023, the effective date was stated as 1 March 25. Now, initially, the Finance Committee, the Standing Committee on Finance, which is the Portfolio Committee of Parliament that looks after all things finance, they had wanted a date of 1 March 24. National Treasury put in the date of 1 March 25, and the committee was very unhappy about that and stated emphatically that it has to be the 1st of March 24. After a bit of a standoff, the Minister of Finance then wrote to the committee and said, look, can we reach a compromise? And they indeed did reach a compromise, and that is an effective date of the 1st of September 24. And so the Revenue Laws Amendment Bill had to then go back for amendment to change the effective date, and it's now been retabled before Parliament. And so all expectations are is that it'll go through and be legislated, and it'll become effective 1st of March 24. And I'll talk a little bit more about that later, but I'm not going to spend a lot of time on it because we did cover it in last year's year-end update. So let's have a look then at these individual announcements. And of course, the one big announcement was this issue around no changes to the tax tables, rebates, credits, and exemptions. Well, that's all very well. At least I suppose some people heaved a sigh of relief that they had not raised any of these tax rates. But as I said earlier, in my view, there was not an option of raising tax rates. But by keeping the tax tables absolutely fixed, what you are actually doing, and we've seen this trick being pulled a couple of years ago, is that you're allowing inflation to do the work for you to collect additional taxes. So what you're doing is you're basically saying, well, by not changing the table, inflation is causing individuals' salaries and wages to increase. And if that pushes them up into the next tax bracket, they're going to end up paying more tax. I mean, just take a simple example. And I want to explain this because I did hear somebody the other day saying that it's not going to make any difference. If you were earning 500,000 Rand a year, all right, in the previous year, you were sitting in this tax bracket over here and you were paying tax according to this calculation. If you then had a 5% increase in your salary, that's purely inflation. In fact, it's hardly even keeping pace with real inflation as it affects households. But let's say a 5% increase. I mean, a lot of people would say you're lucky to get an increase because not everyone's getting increases these days. But yeah, 5% increase would take you from 500,000 up to 525,000. So then it's pushing you into the next tax bracket. So that extra amount, the 525 minus the, call it 513, that extra 12,000 is going to be taxed at 36%. So it's a higher marginal tax rate. All right. So that means that your overall effective tax rate is higher. You're paying more tax. If these brackets had been adjusted by inflation, they would have already factored in that 5% increase. And that means that you would still stay within the same tax bracket over here with a 31% marginal tax rate. But because they haven't changed the brackets, you're creeping up into the next tax bracket. And that's what we call bracket creep or fiscal drag. Bracket creep, creeping into the next bracket, because your salary increases by inflation, you are no better off economically, and yet you end up paying more tax. So it's very erosive, and it certainly generates extra tax. In fact, the projection in this year's budget speech is that this failure to address the inflationary impact on the tax tables, the rebates, the medical credits, all of that is going to produce additional revenue of over 16 billion rand. In fact, that is the one and only big source of additional tax revenue that they have projected in the budget speech. And so not everybody is affected. Obviously, it depends where you are on the tax table, whether you get an increase, how much your increase is, but many people will be affected, and it'll push them up into the next tax bracket. Even if you're already in this tax bracket, it means, you got more that is then subject to 45%. Now, the other interesting aspect, and it links back to what I was saying just now about the big reliance on a very small pool of taxpayers. So there's 25.9 million people actually registered as taxpayers, because as you know, the way that SARS operates is basically anybody who is earning a salary or a wage has to register as a taxpayer. All right, so we got nearly 26 million people registered, but only about 7.5 million actually pay tax. And that could include anyone who pays even 10 Rand of tax. In fact, if you look at the numbers that come out from SARS statistics, there's a very big percentage of the total tax revenue that is actually generated from a very small pool of taxpayers. It's kind of like that 80-20 principle, it could even be a 90-10 principle. That sort of 15% of your taxpayers are generating more than 70 or 80% of your tax revenue. So a huge reliance on a very small pool of taxpayers. Okay, so Wesley's made the point that he saw in business tech that personal tax brackets are going to be frozen for the next 3 years. Well, I'm not sure. I haven't seen anything telling us that that is an actual policy decision. But it is it's an easy way for government to collect extra revenue, that's for sure. And it's kind of like, if you freeze this for the next 3 years, in 3 years' time, we are 3 years behind the inflation curve. And so will you ever catch up? So it's actually having a significant impact on personal taxes, if that is the case. I haven't personally seen any official disclosure around that. But look, it's quite possible. Who knows? What we do see coming through with this failure to adjust the tax tables is also no adjustment to the rebates. So these rebates, technically they should increase by inflation every year. And last year, inflation was 6.9%. Sort of, they always look back the month before. And so last year's budget, they looked back 6.9% in January, and they adjusted these rebates by, I think it was 4.5%. So it was behind the inflation curve. And now this year, last month's inflation was 5.3%, and they have made no adjustment at all. So what also happens, and this is another way of generating additional tax revenue, is that if you keep these rebates fixed, this rebate of 17235 for a person under the age of 65, that creates this tax threshold of 95750. So none of us pays tax on the first 95,000 Rand of taxable income, all right? Because if you earned 95750, you look at the tax table, you're paying tax at 18%. 18% on 95750 comes out at 17235. You take off the rebate, you're back to zero. Okay, so at that point, you're paying no tax. But of course, once you're earning above 95750, and you then, depending on how much higher you go, you're paying proportionately more tax. But my point is this: with the tax threshold of 95750, people who were earning, let's say, virtually at that level, like 95,000 last year, and now if they get a 5% increase in their salary to cater for inflation, it then pushes them over the threshold And then they go from paying no tax to now actually having to pay tax 18% on the amount of their salary increase. And it does create all sorts of other issues because, you know, you have a person who is now a taxpayer. Previously, they were not a taxpayer. And yeah, there's certain practicalities that result from that. Okay, so another concern, definitely a major concern about the fact that, you know, if they're not changing these rebates, it has a very negative impact on your individual taxpayers. And when you look at the medical scheme credit, now here again, some people say, sure, breathe a sigh of relief, at least we still have the credit because, you know, there was mention made about the fact that this credit might be done away with. To generate additional tax revenue to fund the national health insurance. Well, the national health insurance, yeah, well, we know that it's been stated that that's coming. We're not quite sure when it's coming, and it needs so much tax to fund it that we need way more than the tax that we generated from the medical scheme credits. That's the one aspect. Of course, there was a small allocation in this year's budget towards the national health insurance. Fortunately, they haven't made any announcements about doing away with this credit just yet. And I would suggest that it surely can't just fall away overnight, you know. So if they were going to do away with it, they must at least tell people, give people a kind of warning that maybe in a year's time it's going to fall away, whatever the case might be. But absolutely nothing was said about this in the budget speech. But what I have seen are reports from the medical scheme industry, which have estimated that there's going to be a massive fallout of members from medical aids if they did do away from this, if they did away with this medical credit, that the projections are, you know, possibly 1 million people could drop out of these medical schemes because they don't have these credits. You see, I mean, if you add up the monetary value of this medical scheme credit, it looks like a small amount. But if you had a family of 4, husband, wife, 2 children, you know, that's coming out at sort of 1,200 Rand per month. And that's actual cash relief. That's reducing your tax by 1,200 Rand per month. So, you know, that's a lot for anybody, and especially for your families who are struggling with interest rates, buying groceries, paying school fees, you name it. You know, to lose that 1,200 Rand a month benefit, it's understandable that the trade-off might be that, well, then they just can't pay the medical aid tariffs. So yeah, it's going to be an interesting one to see what happens with this going forward. But for now, absolutely no announcement about the medical scheme credit at all. So yeah, we still got it, but it has not increased. And of course, the other aspect with this is that if you think about your medical aid contributions, if you're a member of a medical aid, how much have your contributions increased by compared to last year? Often the medical aid contributions increase by more than the general inflation rate because it's a known fact that medical inflation is usually significantly higher than your general inflation rate. And so although you're paying probably way more than 5% more on your medical aid contributions, you still get exactly the same Rand amount of tax relief. So again, another way that makes people poorer, that they are more out of pocket. Yeah, and I mean, let's not even get into the question of what benefits you get in terms of the medical aid tariff. So yeah, that's another way in which National Treasury does collect more taxes, is by not adjusting these credits by inflation. And then, of course, you know, you're just having that fixed amount of the credit coming off, and of course, more tax being generated. Okay, moving on to investment returns now. Of course, interest exemptions are unchanged. Now, this is an area where we have been told quite a number of years ago, when the new tax-free investment system was introduced, which is probably approaching 10 years ago now, it was announced at the time that the new tax-free investments, that would be government's way of encouraging people to save, and that ultimately this other incentive that came through the interest exemption, that it would fall away. But for the time being, they said there will just be no further changes to this interest exemption. So we don't expect any annual adjustment to the interest exemption. That stays absolutely fixed, under 65s, over 65s. Remember the amendment that came in a couple of years ago, that you apportion now for years of assessment less than 12 months. All right. So if you emigrate during the year, if you cease to be a resident, or a person dies during the year, you have a year of assessment of less than 12 months, you'd have to apportion this exemption accordingly. And that interest exemption, of course, applies only to SA source interest. Now, if you had a non-resident earning SA source interest, remember that non-residents are taxed on SA source income. So potentially this non-resident would have to be taxed on their interest income, but they get a blanket interest exemption under Section 10(1)(h). So it's a full exemption. It's not capped like it applies to us as residents. This is a full interest exemption, but it has conditions attached to it. The non-resident would lose the exemption. So this exemption is either all or nothing. Either you get it or you don't. You would lose the exemption if you were a non-resident who spent more than 183 days in South Africa during the 12-month period leading up to the date on which the interest accrues. All right, so you have to be physically absent for at least 182 days over that 12-month period. And furthermore, the second requirement is the debt that has funded the interest must not be effectively connected to a fixed place of business in South Africa of that non-resident. So it can't be, this exemption applies to individuals and companies. And so that non-resident cannot have the interest arising from a debt that is effectively connected to its permanent establishment in South Africa. If the non-resident loses this interest exemption, and if the non-resident is a natural person, they could then look at this fixed exemption that comes through here. All right, but remember that only applies to natural persons. And deceased estates get the 23,800. Right, if we have a look at your tax-free investments, as I say, this was introduced probably a decade ago, and came in at a fairly low amount, and then it was increased and increased again, and then up to 36,000 from the 1st of March 2020, and no further increase there. This is an important incentive to try and encourage your general population to just develop a savings mindset. We know that South Africans do not have a good track record as far as savings are concerned. We have very high levels of debt and not sufficiently high levels of savings. And the idea with the tax-free investment is just to say, take a small amount each year and you invest that into a tax-free investment. There's no tax incentive for the actual investment, but where the incentive comes in is that the investment return can build up tax-free in that investment. So, it doesn't have to be a savings account as such. It can also be an exchange-traded fund, or some kind of, it has to be a suitable portfolio that has been approved as a tax-free investment. And then if you invest into that portfolio, you could, through that portfolio, be earning interest, dividends, maybe even capital gains, maybe even foreign dividends. But the point is that whatever you are earning in that portfolio, because it has been designated as a tax-free investment, all of those investment returns can accumulate completely tax-free. Now, of course, we know with investments, the huge benefit is that compounding effect. And of course, that is exacerbated the longer you leave the investment, the greater the compounding that happens. And that's where the magic is with the returns on investments. Now, if you can get your returns free of tax, then obviously that's that bigger amount of compounding that happens every year. And so that snowball, as it were, is going to grow to even greater proportions. So it looks like a modest amount, but putting that away every year can accumulate into quite a very nice investment after a number of years. All right, so all of that just to mention that the 36,000 remains the same. Then we get onto retirement funds. Now, first of all, we've got these two special tables that have been around for probably since 2007, 2020, and 2006. And this one applies to your lump sum withdrawal benefits. So if you have investments in a lump sum, in a retirement fund, and you withdraw that before you get to retirement age. Now, generally under the current rules, you can only do that if you actually resign from your job and resign from the fund. And if it's a pension or provident fund, then you could potentially take those funds out, and that will be a withdrawal benefit, and it's taxed according to this table. But remember, this table works on cumulative lump sums, right? Not just on the immediate lump sum that you're taking. So it's quite possible that if you've had other lump sums, it could have pushed you up the table. You end up paying 36% on this particular lump sum that you take out. But the point of the matter is that this is on your withdrawal benefits. And this threshold, in fact, all the thresholds were increased by sort of 10% last year. No further changes. These tables generally don't change very often. And I wouldn't expect that they're going to change much going forward, because they're going to be eclipsed ultimately by the new two-pot system. But having said that, even under the new two-pot system, these tables will still have a role to play, albeit to a limited extent. I'll explain more about that when I get to the actual two-pot system. So that's the withdrawal benefit. And then we have this one dealing with your retirement lump sum benefits, which includes death benefits from the retirement fund, and then also severance benefits that come from the employer, but it has to meet the definition of a severance benefit. That can include retrenchment benefits in certain circumstances. And so here, again, we've got the table from last year, no further changes. The first 550,000 tax-free, and then tax all the way up to 36%. But again, this works on your cumulative lump sums, not just on the lump sum that you are receiving most recently. Again, even under the new two-pot system, this table will have a limited role to play in certain circumstances, and I'll explain that on the next slide. So let's have a look then at the new two-pot retirement system. So as I mentioned earlier, this is going to come into effect from the 1st of September 2024. And the whole idea with the two-pot retirement system is that it's a significant reform, and the purpose is to enable members of retirement funds to to access some of their retirement savings without having to resign from their jobs. But on the trade-off for that is that the other part is then absolutely preserved all the way through until retirement. So currently, with the current system, I mentioned about withdrawal benefits, that for pension provident funds, you would have to resign from your job in order to access those funds, and then you'd pay tax according to the withdrawal benefit table. Going forward from the 1st of September onwards, what will happen is that contributions going into the fund will be allocated by the fund 1/3 to a savings pot, 2/3 to a retirement pot. Now, as far as a member is concerned, you would still make your contributions in the usual way. You would get your tax deduction in the same way as we have in the past, but the allocation will happen in the fund, that they will actually allocate 1/3 to savings, 2/3 to retirement. And the savings pot will be the part that will be accessible. So the member will be able to take their money out of the savings pot if they wish to do so. To manage the administration around that, each member can only make one withdrawal per year, minimum 2,000 Rand. Okay, but you can take the withdrawals out, but the money out of the savings pot without having to resign. And you will not use the withdrawal benefit table here, because any withdrawals from the savings pot will be taxed at your marginal tax rate. So this is not at the special table. This is literally the marginal tax rate. So what would happen is that SARS would have to be requested to issue a directive to tell the fund how much tax to withhold. And they would then look at the taxpayers' tax affairs, and they would say, right, this person was sitting at a 31% marginal tax rate. Therefore, the withdrawal from the savings pot must be taxed at 31%. All right, if the person was earning below the tax threshold, then SARS would come back and say, you don't need to withhold tax. All right, so although the marginal tax rate is from 18% upwards, but they have made the point, or lower, depending on the person's level of taxable income. Now, what's also going to happen is that on the 1st of September, the funds, if you go down to this bottom bullet point over here, the funds will transfer from what is called the vested pot. Now, this is the other very important thing to bear in mind, is whatever you have put into that fund, you're still currently contributing this month, next month, and so on, all the way through to the end of August this year. Whatever you've put in up to the end of August is then what we call the vested pot. So actually, they should call this a 3-pot retirement system. You've got the vested pot, And the reason why they call it vested is because there's a protection of vested rights. So that vested pot, even if you're only going to retire in 10 years' time, what's in your vested pot plus accumulated investment returns will be available to you when you ultimately retire, and your vested rights are protected, so the current rules will apply to that vested pot. In other words, you can take 1/3 as a lump sum, and at least 2/3 must be converted to an annuity out of your vested pot. And so that's why, as far as that vested pot is concerned, even if you retire only in 10 years' time, the lump sum that you take out of the vested pot will still be taxed according to this special table, this retirement fund lump sum benefits table. All right, so this is your retirement lump sum. As far as your savings is concerned, remember from 1 September onwards, 1/3 of your contributions will be allocated to the savings pot. If you take out of the savings pot before you get to retirement age, any withdrawals are taxed at marginal rates. But if you keep some money in that savings pot, whatever's in the savings pot at the time that you retire, that will also be taxed according to this retirement fund lump sum benefit table. All right, so this table, as I say, will still have a role under the new two-pot system, but to a limited extent. All right, because whatever's gone into your retirement pot, the other 2/3 that goes into the retirement pot, that has to stay there until you retire. It doesn't matter if you change jobs or whatever. It has to be preserved until you get to retirement age. And then, very importantly, whatever is in the retirement pot has to be converted to an annuity. Okay, none of that can be taken as a lump sum. All right, so yeah, so it's a very interesting new system that will come into play from the 1st of September. Interestingly, the seed capital, let me get back to that. It took me off talking about the vested pot. But the funds on the 1st of September will take 10% of whatever's in the vested pot, up to a maximum of 30,000. So if this person has 500,000 in their retirement fund investment on the 31st of August 2024, take 500,000 times 10%, 50,000, but you can't go above 30. So the fund will then transfer 30,000 from that person's vested pot into their savings pot. That transfer will take place. It doesn't mean you have to withdraw it. Okay, that transfer to the savings pot is not going to create any kind of tax liability. But if the member does choose to withdraw it, and I think many people probably are going to take this route, they would then notify their fund they want to take the money out of their savings pot. Remember, everyone can make one withdrawal per year. So this is still during the current tax year. They can make this withdrawal from the savings pot. The member goes to the fund and says, I want to take out my 30,000 from the savings pot. The fund then applies to SARS for a tax directive. SARS notifies them, let's say they say, right, this person's marginal tax rate is 31%. So they then have to withhold 9,300 Rand from that 30,000, pay the 9,300 to SARS, pay the remaining 20,700 to the member, and off the member goes. All right. So it has to be done according to a tax directive, and there will be tax to be paid. So this is going to generate a very nice little bonanza for SARS, because obviously a lot of people are probably going to withdraw their 30,000. It's just too tempting for many people to just leave that money there. And so SARS is anticipating this, and they have indicated that they expect an extra 5 billion Rand in tax revenue to be collected this year as a result of people withdrawing their money from their funds. And of course, there's also another aspect to this in terms of the fund leakage that takes place. I haven't seen any numbers in terms of, they must have done the numbers to work out how much is actually going to likely be withdrawn from the retirement capital that is there. If you took how many million people times 30,000 Rand. Wesley says, do you think funds held in the savings pot will be subject to returns that are lower? Yeah, you know, that's an interesting one. And it's a question that's come up a number of times. I mean, if you look at the investment horizon, that savings pot definitely has a different investment strategy, I would think, compared to the retirement pot. I mean, it stands to reason, right? The savings pot, that money it's almost like a money market account. It's got to be accessible. It's a shorter term horizon. Yes, there'll be some actuarial projections around how many people will take the money out and so on. But it would look as if it would have a different return, and yet the funds tell us that there will not be any difference in the returns, that it'll be the same. Well, yeah, it remains to be seen as to whether there's going to be a difference. So Anthony says, are the withdrawals not going to cause an admin nightmare for employers? Yeah, Anthony, I think this is going to be a bit of a nightmare for employers, for the funds, even for SARS, because already, you know, there's a lot of questions being asked. People don't quite understand how this works. How's this going to impact on their savings? How's it going to impact on their ultimate retirement balance, etc.? And so there's, apart from the fact that there's a lot of questions being asked and there's a lot of education that is needed, of course, the pure admin, as far if it's an employer-related fund, it's certainly going to have impact for the employer. But remember that this two-pot system cuts across all retirement funds. So it cuts also into retirement annuity funds. Most retirement annuity funds, there's a very few that are exempt. But those retirement annuity funds, yeah, they're kind of independent from the employment situation. But for the rest, yes, it's going to be an admin headache. You need to kind of get yourself ready for this, because I can't see that your employers will be unaffected. You can't just turn a blind eye and tell people to go and talk to the fund. It's obviously going to affect the employers as well. So I wonder at what point are we going to start seeing some really good communication and education start coming through here? Because I also don't think it's a great idea to just sit back and see everybody plunder and take their 30,000 Rand out of the retirement funds and go and spend it on, who knows what, a trip to I don't even know what 30,000 would buy. And remember, it won't be 30, you're going to have tax taken off that. What will 20,000 buy you, you know? But whatever it buys you, it's gone. It's eaten or it's burnt or whatever the case might be, and then it's gone. So, I mean, people need to actually be cautioned not to take this out of the fund unless they really, really, really need it. And I understand there's many households that are really in a financial predicament and maybe they really do need it. But there needs to be a process of education to try and help people to understand that it's far better to leave this money in the fund if at all possible. I spoke about the compounding effect of your investment returns earlier. It's really not a great idea to rush in and take this money out, because it's, in most cases, it's just going to be spent on consumption expenditure and then it's gone. Yeah, but anyway, so that's a long answer to a short question about the admin that this is going to create. So admin for the employers, admin for the funds, and admin for SARS, because SARS also has to be ready for this huge scale of tax directives that have to be issued. You know, hundreds of thousands of tax directives, pretty much all at the same time. So yeah, hopefully they're up to it in terms of their systems. The other aspect that's also important is that a number of funds have warned that their systems might not be in place for them to literally pay out the seed capital on the 1st of September. And so then you have to have people ready to understand that even though this journal entry takes place on the 1st of September, the transfer across to the savings pot, the funds might not have everything in place. In fact, I very much doubt they will have everything in place, because only on the 1st of September will the members suddenly come in and say, I want my money. At that point, the funds have to apply to SARS for a directive. And how long is it going to take for that directive to come back? And then for the funds to be able to actually make the transfer. So that's another aspect that people need to be ready for. Is there a maximum annual withdrawal? No. All right. So, well, the maximum is whatever's in the savings pot. So whatever's in the savings pot, you can take out, minimum 2,000, but no specific maximum. But you could only make one withdrawal a year. Now, this is another thing, is that if the member runs in and takes their money out on the 1st of September, they need to understand that through to the end of March 25, they can't make another withdrawal. That is their one withdrawal for the year. Okay, and then they have to wait to the following year before they can take the money out then. So yeah, I do think there could be a lot of misunderstandings here, and there's a lot of education that has to take place. But a very interesting reform. All right, if we move on to the company tax rates, of course, no change there. So 27, well, no change as far as our local companies are concerned. So we still have our 27% headline rate, dividends tax at 20%. So our effective tax rates on fully distributed profits is this 41.6%. So if you, for example, had a company with taxable income of 100,000, they paid tax of 27%. It was 27,000, at least 73,000 that can be distributed. We're taking it, fully taxed distribution. That would be 20% on 73,000, 14,600 or 14.6% on the original 100,000. And so that's taking your effective tax rate 27 plus 14.6, 41.6%. And the reason why I put that out there is because it's an important number to use comparing that to your individual tax rates, especially if you've got a owner-managed company and you've got this question, what happens if you leave the money in the company to take out as a dividend versus if you pay that money through as a salary, all right? So important you're comparing that to your individual tax table rates, and then also comparing that to the rates that are applicable to a trust. If you were trading through a trust, it would be a 45%. Okay. Of course, the big announcement with companies is this introduction of the global minimum tax, 15% on large multinational groups of companies from the 1st of January 24. Okay, and well, this is the first announcement we've had on this. I think, this has maybe not been implemented as robustly as it could have been. Yes, we've all known that there's Pillar 1, Pillar 2. I'll come to that in a moment. But internationally, there's been a lot of movement around this area. The OECD has developing policy on this area, and they've basically said this needs to be implemented for years of assessment commencing from 1 January 24. So it's years of assessment commencing on or after 1 January 24. Okay, but it's still coming in pretty much immediately. Now, this global minimum tax, as I say, very much in terms of an international development that has been percolating and developing over the last number of years. I'm sure you've all heard about this concept of base erosion and profit shifting, BEPS, all right? And that's really what's been driven by the OECD, so the Organization for Economic Cooperation and Development. They are based in Paris, and they have a number of, also the G20 has been very much involved with this, but the OECD has, I think currently it's about 38 member countries, and they're all the large industrialized countries, the US, UK, France, Sweden, Switzerland, you name it. South Africa is not actually a full-fledged member of the OECD, but South Africa does have observer status. So we have representatives who attend the meetings of the OECD. And as we know, we've already seen for a number of years that we are very much guided and influenced by the directions that the OECD takes. I mean, even if you look at all of our double tax agreements, the vast majority of our double tax agreements are modeled on the OECD model tax treaty. So we use that same wording that has come through the OECD, and a lot of tax policy, especially around international tax, not only international tax, though, even things permeating into VAT and so on. A lot of it is driven by directions taken by the OECD. And so the OECD has been working on this BEPS project for the last number of years, trying to reduce what they call the race to the bottom. As you have multinational companies trying to enter into various arrangements to minimize their overall tax rate. So if you had a multinational company made up of a lot of subsidiaries deriving profits from different countries around the world, one of the big sort of objectives would be to try and minimize your overall tax rate. And that means you would try and maximize the profits that are coming from your low tax jurisdiction and minimize the profits in your high tax jurisdiction. And as you are aware, we already have a lot of anti-avoidance strategies in place to try and prevent that happening to a greater and greater extent. So we have things like transfer pricing that comes in. We have legislation like your controlled foreign company legislation, and various other things that exist in our Income Tax Act already that have been driven by the BEPS project. And that BEPS project so far has really looked at two main pillars most recently. And the one which is it has already sort of moved quite far. That's been just looking at the digital economy, how to work out where profits and transactions are going to be taxed. And they've developed a multilateral convention to ensure that the biggest and most profitable multinationals reallocate part of their profit to all countries where they sell their products and provide their services. So to make sure that you're not having the skewing of tax, where typically your very large countries are paying very little tax, and they're paying very little tax to your smaller jurisdictions in many cases as well. So it's this question of, especially with your online digital transactions, like international services that are provided, where does that get taxed? If you're sitting here and you are downloading Apple Music on your phone, where is that going to be taxed? Because the music is coming from the US, you're using it here. So it's many of these different things that come in terms of the digital economy and this very multinational aspect of the digital economy to try and work out where profits should get taxed. Now, Pillar 2 is the next phase on from that. So that was the one aspect. They're still working on that, but they've made a lot of inroads there. But now they're going on to the global minimum tax, and this is now the next phase. So this is Pillar 2. They have warned for a while. They've been doing a lot of work in this area for the last few years, and now it is actually becoming a reality. As I mentioned at the beginning, sort of more than 100 countries around the world are introducing legislation around a global minimum tax. So there's different ways that this global minimum tax can work, but South Africa has taken a particular approach, which is a kind of a top-down approach. Now it's going to apply to multinational companies with annual revenue exceeding 750 million euros, okay, because this is the number that's been driven by the OECD. Remember, I said they're based in France. That's why they use euros. So if you had to translate that to rands, we're talking about 15 billion rand per annum in terms of consolidated annual revenue for the group. And that would be a group that is hosted in South Africa. So you're only talking about your large companies here, but there are a number of them that will be affected. And in essence, what you would do, yes, you have to make certain adjustments and so on, but to put it very simply, you would add up your tax that's paid by all the various companies in the group, divide that by your annual revenue, which has made certain adjustments and so on, to come out with your effective tax rate. And if the effective tax rate overall is less than 15%, then you would have to make an adjustment. And the way that South Africa is doing it is with an imputed income adjustment. And that would generate the additional tax that's needed to get your effective tax rate to at least 15%, regardless of where the profits are located. So for South African-based multinational groups, this is expected to generate additional tax revenue in South Africa. All right. I mean, other countries will also have their own impacts, but yes, it is expected that we will generate additional tax. And I think they are budgeting for an extra sort of 6 to 8 billion rand a year that could come through from this. So it remains to be seen. At the moment, we've got 2 draft bills for public comment, the actual tax bill and then the tax administration bill. They are both available. They're not terribly long bills, and they refer very extensively to the OECD documentation. So you really have to read the 2 together, or the 3 together, both bills and the OECD documentation. There's also an explanatory memorandum that has been published by National Treasury. And these bills are open for public comment up until the end of March. And then no doubt they will then be finalized and they will come through in their final form. So this creates an interesting scenario, because usually with the proposed tax amendments, those would come through in the draft tax bill that's released in sort of July, goes through the whole public submission process, gets finalized by October, and then ultimately gets promulgated. Because this has really come into effect, it's affecting years of assessment commencing on or after 1 January 24, it looks like this could be fast-tracked to some extent. Also bearing in mind that this legislation is very much driven by the OECD. And so it's following what's already happening in the rest of the world. All right, but nonetheless, we need to look at this very carefully and make sure that it does work properly in South Africa. So will the 15% tax be based on turnover or taxable income? Well, it's actually a bit of a hybrid. As I say, you take your consolidated annual revenue and And then you make quite a few adjustments to that. And so it's quite a theoretical calculation that's done at the end of the day in terms of working out that 15%. So it's not just it's kind of like on taxable income, but it's not quite taxable income. So it's kind of net profit, but it's net profit with various adjustments. Okay. All right. So that's going to be a very interesting development. Getting back to things that are not changing, our small business corporations completely unchanged from last year, even the threshold the same, because obviously that links to the threshold for individuals under the age of 65. And our micro businesses also unchanged. In fact, that's been unchanged almost 10 years now, since 2015. Although we still have micro businesses, and there's even new micro businesses that get registered, but very much the same table that is used. This is based on taxable turnover, right? To work out the tax that they actually pay. And then on to individuals. So the travel allowance table for the next year, the year that we've just started, that goes through to the end of Feb 25, we have got a new table that has been released by SARS. This has also now been gazetted. You can actually get the table that has been published in the Government Gazette. And you'll see, compared to last year, these thresholds on the left are all exactly the same, the brackets, as it were. Even, above 700,000 and then over 800,000, those amounts the same. But the rand amounts and the cents per kilometer in these columns have been adjusted. So a bit of an inflationary adjustment across the board here. Fixed cost pretty much going up fairly small, only about 2%. Fuel costs going up about 7%. And maintenance costs going up sort of 5% in line with inflation. So at least those have been adjusted. What we also have is your fixed rate, what we call the simplified method. And that is if you reimburse your employees for business travel that they've actually done. It can be a totally tax-free reimbursement. If you reimburse up to this fixed rate, which is now 484 per kilometer, it's gone up from 464, so a very small increase. But that is what can be tax-free as long as you have no other reimbursement paid to that employee. So it says here, they get no other compensation in the form of an allowance or reimbursement other than for parking. You can reimburse for parking or toll fees, but nothing else, okay? And so this is kind of the only thing that you're reimbursing them for other than parking and toll fees. Then you can pay up to this amount as a purely reimbursable allowance, tax-free. But if you pay anything more than this, even if it is the only reimbursement that you're paying, if you pay 6 rand per kilometer, then the excess is going to become fully taxable. And that's taxed under Section 7B, which means it's taxed as and when you actually make that payment to the employee. All right, and then we go on to the subsistence allowances. I was quite interested when I looked at this, that, here suddenly we do see inflationary adjustments coming through. So many other things stayed exactly the same, but the subsistence allowances we see that has received quite a lot of attention. So the meals and incidental costs, okay, sure, it's only a 5% increase, but, bearing in mind that we've had no increases to most of the other things as far as individual tax is concerned. So meal and incidental costs going up 522 up to 548 per day. Incidental costs also a 5% increase. And then interestingly, travel outside the Republic. We now see a new table being gazetted. So the last time they changed these rates was in 2019. And now we see a whole new table being published. Not every rate has changed. I mean, I haven't literally compared every single country because it goes on for about 8 pages. But we get, for example, France is still at 128 euros per day. That's unchanged. The USA has seen a 15% increase from $146 to $168 per day. But bearing in mind that increase is covering 5 years worth of prices. But what is also interesting, of course, is that you're going to translate these amounts to rands. So if you think about the rand exchange rate in 2019 compared to now, you're going to come out with a much bigger rand value. But nonetheless, even the US dollar amounts have increased and the British pound amount has increased by 12%. What is also interesting is Eswatini, which is in rands here, has increased from 818 to 1367 per day, a massive 67% increase. So not quite sure what's been going on there. I don't know what the inflation rate is in Eswatini, but I don't think it's in that realm. But yeah, certainly a very big adjustment that's taken place. And then other countries that are not listed. And as I say, there are many countries that are listed. I've just taken a sample here. But any others that are not specifically listed in the table that has been gazetted, then you would use $215 per day. And that's unchanged. But of course, yeah, again, taking the exchange rate into account, you would get many more rands per dollar. Okay, then they also have this other provision dealing with day trips. And here they have an amount, 169 per day, was 161. So again, that's sort of 5% increase. And then and then after this is probably a good time to take a break, just finishing off on individuals. Of course, the big question is what's happening about remote working arrangements? Weren't we going to see some kind of change in legislation? Well, of course, the working from home situation all reached a crescendo in 2020 and 2021 with COVID, everybody suddenly working from home, using a place at home to work, having to incur certain expenditure, and then looking at whether they could claim their home office allowances. And of course, there are certain limitations that come through there because Section 23B says that you can't claim private expenses, except that there is a carve-out for home offices in certain circumstances, as long as you meet certain requirements. But then there's the other complication as far as your employees are concerned with Section 23M. So you have to look at how those sections kind of work together. Now, it was stated that SARS and National Treasury were going to undertake a multi-year project, starting with consultations in 21, and they would generate a discussion document. And out of that, we were thinking that there might be some kind of shift in terms of the tax treatment for home offices, but actually nothing has happened. They have updated the interpretation note number 28, which describes SAR's interpretation of these various provisions. That update was done in March 22, but since then, nothing else has happened. Last year, they still promised a discussion document, but there's nothing really that has been forthcoming. And I think the conclusion to be drawn is that we should not expect any changes in tax legislation around remote working arrangements. It doesn't look like it's a priority, and it doesn't look like anything's going to change as far as that's concerned. So we're still working with the Income Tax Act 23B, 23M, and of course, interpretation note number 28, issue number 3 from 2022 is what we use to see the SARS interpretation on that. All right, and that's basically where we are with remote working arrangements. And it brings me into basically 2:30, and we promised to take a break at 2:30. I'm sure you're in need of a break. If you've got water, which most of Joburg doesn't have at this stage, then hopefully you can get yourselves a cup of coffee or tea. But whatever, I will see you back here at 2:45, 2:45. Okay, so Danny, I don't know if you've got a little clock that you can set there, or shall I put it on the slide? I'll put it in the chat, all right, just in case anybody has been away and they wonder where we've gone. I'll pop it in there that I'll see you back at 2:45. Thanks, everyone. See you then. Okay, right. Welcome back, everybody. And before we go on to the next slide, we're going to talk in the next section about capital taxes. But Ian raised a question around the two-pot system. Does an employee have the option for a savings pot not to be created on their account? And the answer is it's not catered for. So no, it seems that will not be an option, that everybody has to move into this new system whereby 1/3 of your contributions will be allocated to the savings pot. Okay, yeah, so not optional. Right, let's move on to the capital taxes then. And looking at estate duty, well, nothing happening here. Still the same rates that apply. And the abatement the same. Now, what is interesting here, of course, we could just go on to the next slide and leave it there. But again, if you look at this abatement, 3.5 million, last amended in 2007. If you look at the inflation index between 2007 and 2024, it would seem that this amount would probably be closer to sort of 10 million or 9 million in today's value. So the fact that they've kept it at 3.5 million means that there's a lot more people who end up paying estate duty when they're not even particularly wealthy. I mean, having an estate of 3.5 million, if you just think about having a fixed property and maybe a few savings, okay, sure, your retirement savings is probably not going to be in here because there's only certain aspects that would come in. But yeah, this is not a wealthy person that has assets worth 3.5 million, and yet you end up paying estate duty. We're not seeing massive increases in the amount of estate duty that's collected. But yeah, this certainly exposes many more people's estates to estate duty. And even the 30 million, well, that came in probably about 5 years ago or so, that anything above 30 million is taxed at 25%. But yeah, 30 million, at least you're into a different kind of ballpark in terms of wealth and so on. But certainly not changing 3.5 million, I think, is very unfair. The donations tax also, the 100,000 annual exemption also last amended in 2007. So that should probably be sitting closer to 250 or even 300,000 in today's terms, and yet only 100,000. And then above that, any donations are attracting donations tax at 20%. And when go over the 30 million limit, it's 25%. So the effect of keeping these amounts fixed is quite unfair on the taxpayer and is generating more tax. I mean, it's surprising in a way that we are not seeing more impact on the reported tax revenues as a result of these items being fixed. If you look at the CGT exemptions, the annual exclusion that we all get, 40,000 Rand, that was last amended 8 years ago. At that stage, the JSE index, it was interesting to compare that. Now, of course, not so interesting because the JSE hasn't done particularly well in the last short term. But the JSE index is probably sitting at around 74,000 now, thereabouts. And if you looked at the inflation between 2016 and now, that should probably be sitting closer to 60,000 as opposed to 40,000. So it means that many more people end up paying capital gains tax on capital gains that shouldn't really be coming into the scope of capital gains tax. Annual exclusion, the year of death, and all of these other exemptions were last changed in 2012, so 12 years ago. The primary residence exclusion I find particularly unfair because sitting at 2 million Rand from 2012, so currently that should probably be closer to sort of 4 or 5 million Rand, at least, if not more. And so you're ending up with a lot of people paying capital gains on the sale of their primary residences, even though the property prices have not increased that much, but cumulatively over a period of time, if somebody's owned a home for 30 years and they now want to sell the house to possibly downscale or move into a retirement home, and they end up having to pay capital gains tax on that house, which is iniquitous. Because, the way that this was scaled at the time would mean that only very large, valuable homes, etc., really something into the realm of wealth taxes would attract capital gains tax on the sale of your private home. And then the sale of small business assets also, that 1.8 million exclusion, it's paltry. And the thing is that you only get that exclusion if the value of your assets does not exceed 10 million Rand, and that 10 million also hasn't changed since 2012. Now, the reason why I feel quite strongly about this also is because if you think about the policy intent when capital gains tax was introduced back in 2001, there was a lot of discussion about whether we should have an indexing system or not, and you should probably only pay capital gains tax when you have a real gain on the sale of an asset, not just an inflationary return, if I can put it that way. But it was decided they would not adopt an indexing system, but they said they would make sure that these exclusions would keep pace with inflation. And the fact that that hasn't happened, I think, is a very negative situation. Now, Mark has asked, will there ever be an adjustment to the VAT registration? Well, that's another one, of course, that hasn't changed for a while. That has a slightly different intent. So SARS' intention with keeping that 1 million rand at 1 million is very deliberate to make sure that more and more businesses would have to register for VAT. So it's almost like SARS would prefer them to be on the register so that they can keep an eye on them and make sure that they collect the VAT. So their intention, and I have heard this stated at SARS a few years ago, is that they don't plan on increasing that 1 million rand anytime soon. But I mean, I heard that quite a while ago. So the fact that it's still sitting at 1 million maybe just underlines the point that they just keep it there and then just allow businesses to have to come into the VAT net. And then you end up with all the compliance and so on that has to be done. But yeah, that is quite deliberate and quite intentional. Well, so is this, what we see on the slide in front of us. This is very intentional, and it is a way of generating more tax. So the next time you hear somebody talking about whether a new wealth tax should be introduced, we need to point out to them that we already have wealth taxes. We have estate duty, we have donations tax, we have capital gains tax, we have transfer duty on the transfer of fixed property. And the fact that these exemptions are not being adjusted means that we have even greater exposure to capital gains tax that would have been the case. So there's no scope, I don't think, to introduce a new wealth tax. All right. Then going on to the next one, well, the CGT inclusion rates, of course, that's just a function of the tax rates. So for individuals, we include still 40%. Companies and trusts other than special trusts include 80%. And then, of course, that flows through to your effective tax rate. So individuals, maximum 18%. Companies, unless it's a small business corporation, it'll be 21.6%. And trusts at a 45% tax rate. So this is other than special trusts, will have an effective tax rate of 36%. All right. Transfer duty, as I mentioned, no change since last year. We had an adjustment from the 1st of March 23, but that now stays the same. Well, I'm not too surprised about that one. At least we did have an adjustment last year, and property prices haven't increased significantly. In fact, I heard that FNB had put together some stats on the increase in residential property prices over the last number of years. And their findings were that property prices were only increasing around 1.5% year on year for residential property. Obviously, I think that depends on where you are. That's in Gauteng. I think if you're in Cape Town, it would be a different story. But certainly across the board, property prices are not increasing that much. So the fact that this table hasn't changed, that doesn't give me a headache. But the CGT exemptions not being changed, that does make me very annoyed. On the tax incentives, so the only thing that's changed here is your learnership allowance, and that's now been extended for another 3 years. So that is good news because many accounting firms make use of the learnership allowance. Many of you are involved with accounting firms. And of course, there's many other kinds of businesses that make use of the learnership allowance as well. I think it is quite broadly used and it's quite effective. So at least you will still have that now for another 3 years. Then, of course, the other big announcement, what I do just want to mention when you're looking at tax incentives, this is not an incentive, but I thought I must just put it on here. The Section 11E, the wear and tear allowance. Remember that we have that 100% write-off on small assets up to 7,000 Rand. And that also has not been changed since 2009. And I saw that SAICA had put in a submission, they put an Annexure C submission into SARS and National Treasury, or specifically National Treasury, calling for many of these things to be attended to, and it has fallen on deaf ears, but really the 7,000 Rand does need to be adjusted. It's way out of date. That would be, I think SAICA was calling for it to go up to 25,000, and what a difference that would make for any business that's using small assets up to 25,000. And it also simplifies the administration if you could just write that off in full, as opposed to doing the whole wear and tear allowance on 3 or 4 or 5 years. Then the big new announcement is this new tax incentive for manufacturers of vehicles powered by electricity. Well, yeah, that's an interesting one in South Africa, and hydrogen. But of course, electrical vehicles, we are seeing there's a huge uptake, a huge trend towards electric vehicles, especially when you travel outside South Africa. We do see some in South Africa as well, of course, but nowhere near the numbers that you're seeing overseas. And of course, our vehicle manufacturers do export many of their vehicles, and so they need to be producing products that are required internationally. And so this move towards electrical and hydrogen-powered vehicles, not just for the export market, but also in terms of sustainability, sustainable development goals, and making use of low carbon alternatives, and just doing what's good for the environment. So it is a development that is happening, and we sort of catching the wave now. Might be a little late, but nonetheless, we are looking at introducing this incentive in 2026, and it will be 150% allowance in the first year for new investments on or after 1 March 26. Now, you might say, well, why so long? And the answer was provided in the budget documentation to say that there's a lot of research that has to be done, and they need time. Both government and investors need time to properly consider what needs to be done and what they need to invest in. And that's why they're not just going to introduce this immediately. Well, we'll have to wait and see what happens with that. Okay, we've got a question. If you are of retirement age and have a paid up RA with a value of 1.5, will it be advisable? Okay, look, I can't give financial advice, but I can tell you what you can do. Of course, what you can do, if you've got a paid up RA, you can cash it in before September. If you leave it there, if you feel like you don't need to take the money off, obviously an RA, you can only take 1/3 as a lump sum. The other 2/3 would have to go as an annuity. If you left it there, that would be your vested pot. So your rights would not be affected, even if you only access that money in, say, 5 or 6 years' time. It's only what you contribute from the 1st of September 24 onwards that would be different in terms of being allocated between the savings pot and the retirement pot. All right, so I don't want to cross the threshold and start giving advice, but that's just to give you some perspective so that you can make your own decisions. Right, on specific excise duties, as I mentioned in my intro, every year we have increases to the excise duties, and usually above inflation increases. Now, last year, interestingly enough, with all the submissions that were made on the draft legislation, there were a huge number of submissions that were made around the sin taxes, especially on cigarettes. And of course, there's a massive problem in South Africa in terms of the illicit trade in cigarettes, and I'm sure it carries over into the alcohol side as well. But especially with cigarettes, we know that this is a major problem. And so there was a lot of submission around the fact that our excise duties are too high and that we need to pull back. And so government this year in the budget documentation issued these stats to say the guideline excise burdens are as follows. This is obviously your excise tax in relation to the retail price of the goods. And they say, you know, guideline internationally, you could go up to 11% on wine, 23% on beer, 36% on spirits, 40% on tobacco. Now, of course, it depends what your retail price is and what you're actually paying. In terms of your excise taxes, I'll leave you to do your own calculations. But what government was saying is that we're not at those levels yet. So there's still scope for increases. And so here we do see increases above inflation coming in. The only thing that's slightly below inflation is indeed on cigarettes. And that's probably linked to the submissions that were made last year. So if we look just quickly at this table, I've just taken a bit of a selection out here. If we look at the change, so malt beer, 6.7%. The higher ones are on wine, 7.2%. I saw that the wine industry had actually made a representation saying that this is unacceptably high and it's negatively impacting the wine industry. Ciders, spirits, etc., 6.7%. And here you get your cigarettes and cigarette tobacco and vaping. they got off lightly, only a 4.7% increase there. So that's kind of just in line with inflation. And then your pipe tobacco and cigars way up at 8.2% increase. All right, so these increases all came into effect, obviously, on the date of the budget speech. Then let's talk a little bit about the fuel levies. I pointed out earlier how much, well, just a sort of a rough estimate of how much additional fuel levy government has collected this last year as a result of load shedding, and many people in various forms, companies, individuals, NGOs, you name it, have had to run generators in order to even remotely try and keep their operations going. Well, the fuel levy government has said, well, they'll be nice and they won't increase the fuel levy. They'll keep it fixed, and that's going to result in tax relief of around 4 billion rand. Well, that's comparing what they would have got if they had increased the levy by inflation, I suppose, compared to the fact that they haven't increased it. So what they have not increased is your general fuel levy. You can see that's the same petrol, diesel, and the road accident fund levy is exactly the same. Customs and excise levy stayed the same for quite a while, but what has increased comes through from carbon tax, and that's the carbon fuel levy. So you'll see on petrol, it goes up 1 cent from 10 cents to 11 cents a litre, and on diesel, it goes up from 11 to 14 cents. So there is a little bit of an increase in the actual total levy, but the general levy and the road accident fund levy have not been increased. So it'll be interesting to see going forward, you know, how much addition it's actually going to impact on government. Because if you go and buy diesel to run in your generator, in many cases, you're paying this full manufacturers last year. But those are the only exceptions that you get, really. Otherwise, everybody else is paying the full levy on their diesel that they're burning up in generators in order to keep the lights on. Yeah, so I think it's quite an unfair situation again, and it's something that I think needs to be explored and kind of maybe looked into in more detail to kind of see really what's going on and how much extra tax revenue, you know, is government really getting as a result of the load shedding situation. All right. But moving right along, let's have a look at the other environmental taxes. And I mentioned at the beginning that there's increases across the board as far as your environmental taxes are concerned. So your plastic bag levy, this is one of these things that we call stealth taxes, because you don't really notice this, but it's in the background and it just creeps up. And have a look at this rate, how it's increased from 2004. Now, just think about those exemptions and abatements that we looked at earlier on capital taxes and the fact that no change has taken place there, the 3.5 million, the 2 million primary residence exclusion, etc. And yet here we've seen these massive changes coming through. So no shortage of inflationary adjustments here. In fact, even going through from this year, from 1 April 2024 onwards, we're going up from 28 to 32. So that's like a more than 10% increase that's coming through there. Okay, sure, they did introduce a reduced rate in 2021 of 12.5 cents per bag on bio-based plastic bags, those kind of very flimsy, brown-looking plastic bags that carry a reduced rate. But apart from that, your plastic bags are certainly generating more and more and more, except for the fact that I think you'll probably find that fewer plastic bags, I would venture to say, fewer plastic bags are being used because there is the general awareness of the damage that's done to the environment. And so people pull back on using plastic bags. Now we all use the Woolworths bags, right? And sometimes people end up collecting those. And that's a whole different ball game. But as far as the plastic bag levy is concerned, yeah, certainly quite a big increase coming through there. And then another one, the incandescent globe levy, looking at the high wattage globe, the old-fashioned light filament, and there to discourage people from using those globes and get people to rather switch over to the low energy option. We see this rate that was introduced and has also increased quite significantly. And this year, a 33% increase in the rate. But there again, I think these globes are falling behind and they're a little bit obsolete. I don't think too many people use these globes anymore, so I'm not quite sure how many get sold. I would venture to say that there's far fewer that have been sold over the last few years. Of course, what we also see is the motor vehicle emissions tax, and that was introduced in 2010 to, again, as an environmental tax to try encourage people to rather look at low emission vehicles. So vehicles that don't generate too much carbon dioxide. So this is measured as to how much carbon dioxide is emitted by the vehicle, all right? And if you go over a certain threshold, then you pay this rate. So if you buy a nice little vehicle, electric vehicle probably wouldn't have any emissions, then you don't have this emissions tax. But if you buy a big 6-cylinder double cab that's going to generate a lot of carbon emissions, then you're going to pay a lot of emissions tax. And this tax has increased over the years. They also changed the threshold. So from 120, it went down to 95. So there's more exposure to the tax. And you see that even the rate here has increased. And this year it's going to go from 132 to 146 on passenger vehicles, and for double cabs from 176 up to 195. So it's 11% increase coming through there. So there you would see that when you buy the vehicle, you actually see it on your invoice. The manufacturer would specify what the emissions are, and they would charge this tax accordingly. Another very interesting one, I don't think you could call this an environmental tax, more like the health, as it's called, the health promotion levy. It's the sugar tax. And this was introduced back in 2018 to try and reduce people's propensity for sugary drinks, and especially your fizzy sugary drinks like your Coca-Cola, Fanta, cream soda, whatever, all right? Back in the day, they all used to be just one type of Coke, one type of Fanta, and it all was the full sugar variety. Of course, what we've seen in most recent years is there's a much greater variety available. You get low sugar, caffeine-free, etc. And I think a lot of that has come about since 2018 because the manufacturers of these cold drinks, certainly the large ones, seemed to then diversify and start developing low sugar options so that, probably for the health reasons and also, well, perceived health reasons, it remains to be seen whether it really is healthier for us, but it has less sugar, so that's good. And it also then avoided this sugar tax. But the sugar tax definitely did have a very negative impact on the sugar industry. And there was a sort of a double or a triple whammy on the sugar industry because they also suffered severe floods. And of course, they had the riots in KZN, which affected the sugar industry quite badly. And there was also sort of international competitive forces that worked against the sugar industry in South Africa as well. So we've seen the sugar industry reeling since this tax was introduced. And the tax is one reason for the hardships that the industry has suffered. What this has meant is that the increase in this tax, the rate that was supposed to come in 2022, was then postponed through to 2025. So that does look as if it's still on the horizon, that we'll see this increase coming through. But just to see how the sugar tax actually works. So it is now sitting at 2.21 cents per gram, in excess of 4 grams of sugar per 100 mils. So if you poured some of your liquid, or you look on the bottle of the cool drink, you can actually see there, it tells you what the sugar content is. And if it's above 4 grams per 100 milliliters, then the sugar tax kicks in on the excess. And the reason why they use 4 grams, what's magical about that, is they say that's pretty much equivalent to 1 teaspoonful of sugar per 100 mils of liquid. So if the sugar content goes above that, then the sugar tax gets paid on the excess. And as I say, that rate was due to go up to 231, but it was postponed, but it's due to come in 2025. But then what they also have indicated is that in 2025, they're probably going to increase the scope of this tax. So it's not good news at all. So the rate is proposed to go up. And they've said they're also going to release a discussion paper for consultation on proposals to extend the levy to pure fruit juices and lower the 4 gram threshold. So, even a lower sugar content threshold, you go above that, you're going to end up paying the tax, you're going to pay the higher rate, and to extend this to pure fruit juices, which I think is, what can you do about the sugar in a pure fruit juice? It's there. It's nature, it's how nature intended. But if it's above whatever the threshold is, then that fruit juice will also give rise to sugar tax. All right, so who says money doesn't grow on trees, right? So it's going to trigger its way all the way through to taxes for the government. All right, so that's on the sugar tax. Then the carbon tax, and I guess a lot of this kind of sort of underpinned by the carbon tax, because that is our big sort of environmental tax, to try and encourage low carbon options as far as manufacturing processes are concerned. They're sort of, again, promoting sustainable development goals and so on. This was introduced in 2019, and we've already gone through sort of the first phase of the implementation. Initially, this rate per ton was going to increase just in line with inflation. So annual inflation rate plus 2%. That was annually all the way through to December 22. And you can see those increases coming through here. And then suddenly, boom, big jumps after that. And that's because National Treasury last year put together the rates for like the next 10 years. Initially, they said they're going to peg it to the US dollar. And then after submissions, they said, okay, they'll de-link it from the dollar, but they put out the rates as they had them. And they have significant increases. As you can see this year, from the 1st of January, the rate increased by 19.5%. So this carbon tax is definitely becoming more intrusive. It's certainly costing more. And it's a stealth tax because we don't see how much carbon tax we're paying as consumers, but definitely this carbon tax is factored in to the price of goods and services, you know, from Eskom to Sasol to ArcelorMittal to various other manufacturers. They would end up paying this carbon tax, and the cost is inevitably passed on to the consumer. Right, then just to tack on to the SARS interest rates. As I mentioned earlier about the interest rates increasing almost every time the Monetary Policy Committee met over a period of about 18 months, I think it was, we saw the interest rates going up and up and up. And then it sort of stopped for a while, and we haven't seen any further changes. And as I mentioned, we have to sort of wait and see what's going to happen over the next year. So currently, where we are right now, if you pay interest to SARS, the rate is 11.75% per annum. If SARS pays interest to you, if you're lucky enough to get interest from them, they'll pay it 4% different, 7.75% per annum. And then, of course, we have the official rate of interest, which is very important because that's the benchmark that we use when we are looking at low interest loans. So if you're looking at low interest loans for fringe benefits tax purposes, or you're looking at a low interest loan advanced to a trust for Section 7C, the deemed donation purposes, or you're looking at a low interest loan advanced from a company to a resident shareholder, there you're looking possibly at the deemed dividend under Section 64E4. And there you will always say, what is the interest rate that would have been charged at SARS official rate of interest versus what is the interest that was charged? If it's an interest-free loan, nothing. And so that gives you interest differential that then generates either the fringe benefit or the deemed donation or the deemed dividend. And so there we're measuring against currently 9.25% per annum. And that's been the case since June last year. And it seems that that's going to stay still for another couple of months, at least. All right, so those are the interest rates that you need to think about. Then the next part of the presentation, and as we sort of come in towards the end, this is looking now at the Annexure C proposed amendments. And these are the more technical amendments. So Annexure C is a separate part of the budget documentation that links all the technical amendments that are going to come through, that are going to be proposed and then ultimately promulgated as we go through the legislative process this year. And so this year we see that there's going to be changes to the Employment Tax Incentive Act, curbing further abuse of the ETI. And there's also changes to the Income Tax Act, the VAT Act, and the Tax Administration Act. And so typically what would happen is that we see these changes, we see the proposal in the budget speech in very broad terms. It doesn't give us a lot of information typically and leaves us all guessing to some extent. Then we wait for the draft legislation, and that will come through around about July. That'll be open for public comment, normally until about the end of August. And then based on the submissions that are made, that then is adapted through to the final bill, which is then tabled when the minister tables his budget speech in October. And then ultimately that final bill will be promulgated. That's the normal course of events. So we can expect the draft bill, I would say, around about July, that will give us further information about these amendments. So if we look at the income tax amendments, and as you can see, there's quite a number of them there. I'm not going to talk to all of them. In fact, I'm just really going to focus on maybe one or two. But you can see that in many cases, the amendments that are coming through here are because there's technical problems around the existing wording of certain provisions, like this definition of remuneration proxy. We use that term in a number of different contexts, and it really means looking back to see what remuneration did this person earn from this employer in the previous year of assessment. And we use that as a proxy for this current year. But it talks about remuneration from the employer, and it doesn't talk about associated institutions. And so they're going to extend that definition. With 11NA, that's a special deduction that applies if a person has received an amount of income, because of course you bring an amount into gross income the earlier of receipt or accrual. So they bring the amount into gross income, and then later they have to refund some of that amount. Like, let's say, for example, a person earns commission, but then later, because maybe some of the debtors didn't pay or the sales were cancelled, they have to then return some of that commission. And they would then get a deduction under Section 11A for the amount that has been refunded. Now, when we translate this across and look at the employee's tax situation, the payroll situation, when an employer is working out employee's tax, obviously you work on net remuneration. And that means remuneration minus certain deductions that are permitted in terms of the fourth schedule. And there's very few deductions that the employer is allowed to take into account. They can take into account your pension fund contributions and Section 18A donations if it's through the payroll. So it's very limited in terms of what they can take into account, but it looks as if they want to bring this in as something that the employer can take into account. And their justification for that is that the payroll reconciliations will have to be done on a month-by-month basis going, well, the effective date of that is still to be introduced, but SARS has already told us previously that they're moving to a monthly reconciliation at some stage, as opposed to the 6 monthly reconciliation that happens currently. And they're saying with that move to the monthly reconciliation, they want to amend this and bring it in as something that the employer can take into account. And then the Section 7C and 31 interface, I'll come to that on the next slide. Section 12B limits. So Section 12B is typically your 50, 30, 20 allowance that is used not only for farming assets, but also now for renewable energy production, your wind farms, solar, etc. Of course, it's been sort of eclipsed for 2 years while we have the Section 12BA incentive, because that gives you your 125% deduction in year one. But of course, the Section 12BA is only around for 2 years, up to the end of March 2025. And what is interesting with Section 12BA is, although it talks about your wind farm, your hydropower, your solar energy, and so on, but it does, in terms of the solar, it works according to, it doesn't have any caps, all right? But Section 12B does have a limit. It has 100% write-off if you've got solar up to 1 megawatt. And so now the thinking is that maybe that 1 megawatt needs to be raised, or maybe they should just take that limit away, because Section 12BA doesn't have any limits. So they're going to be reviewing that, and we'll see what comes through in the draft legislation. And then other aspects, involuntary transfers between retirement funds for people over the age of 55. That's fixing the wording that is there, but it's a bit messy. And then the Section 1 definition of connected person with partnerships. This is especially with on-commandite partnerships, which typically are secretive. You don't know who the other partners are. And yet, when you look at the definition of connected person, any partners in the same partnership are connected persons. But that's a bit tricky if you don't know who the other partners are. And so they are looking at that definition of connected person in relation to those on-commandite partnerships. Interest limitation provisions, 23M, 23N, where we've seen this being adjusted year after year after year, and there's still more changes that are coming through there. The assessed loss restriction rule. Now, this is an interesting one that I should just talk about quickly. This was the limitation that was introduced last year, that your assessed loss is limited in terms of how much can be set off against the current year's taxable income. And it's capped at the greater of 80% of current year's taxable income or 1 million rand. Okay. Now, if you have a company that's in liquidation or in the process of being wound up, they could be subject to that 80% limitation, which would then result in them having an additional tax liability that comes about, although they've got this massive assessed loss and then they haven't been able to utilize it. So they're going to basically say that this restriction rule will not apply to companies that are in the process of being wound up or liquidated. Anthony, yes, the solar rebate for individuals ended at the end of February this year. Yeah. Corporate reorganization rules, yeah, again, you know, more and more technical wording that has to come through every year. And so they're working on some of those provisions again. And then the 6-quart rebate for your foreign taxes paid by a resident. There's some adjustments that have to be made there for rebates in relation to capital gains and controlled foreign companies. Okay, so let's just talk about Section 7C and Section 31. Now, Section 7C, as you know, is the provision that talks about the deemed donation. I referred to it earlier when I was talking about the SARS official rate of interest. So it applies when you've got a loan advanced to a trust or a company owned by a trust in essence. That's generally where it comes in. And of course, you would say, what would the interest be if you use the SARS official rate of interest minus what is the interest that you're actually charging? And that interest differential on a year-by-year basis becomes a deemed donation made by the individual behind the loan. Now, there are certain exclusions in Section 7C5 that says Section 7C does not apply in certain circumstances. And one of those is where you've got a loan that constitutes an effective transaction as defined in Section 31(1) that is subject to the provisions of that section. So that's excluded. So in other words, Section 7C does not apply to that loan. But when we talk about an effective transaction, so we're talking about a cross-border loan, okay, and it's between essentially connected persons or associated institutions. So this cross-border loan between connected persons, like maybe you've got an individual who has advanced a loan to a family trust, could even be at that level. Okay, now the question is, it's not just where you've got an effective transaction, but it goes on to say that is subject to Section 31. In other words, it's an effective transaction and you have got the application of the transfer pricing provisions that come in there. So what would happen is that if you as a resident advanced an interest-free loan to an offshore trust, let's say, that is a connected person to you, you would say, what is the market-related interest rate on that loan? Not the SARS official rate at this stage. For the purposes of Section 31, you're saying, what is the market-related rate? If the market-related rate was, let's say, 5%, and it was on a R1 million loan, then you would say, is there any benefit to the resident as a result of not charging interest? And yes, there is, because you don't have a tax liability on that interest. And so then you would have a transfer pricing adjustment that comes through to the extent of the interest differential. So that 50,000, 5% on R1 million, you would have to do a primary adjustment, which actually raises that in your taxable income for your resident individual, all right, because you haven't charged interest. If you had charged interest at the market rate, you would have got this interest of 50,000. So you have to make that primary adjustment into your taxable income calculation. And then there's a secondary adjustment that comes through that it's a deemed donation. The same amount is also a deemed donation. All right, so you've got both of those adjustments that have to happen. And so the point of Section 7C5 says that if you've done that, if you've made that adjustment under Section 31, then Section 7C will not apply to that loan. But now if you think about my example, the 5% interest rate, but now the SARS official interest rate is 9.25%. We've only done a 31 adjustment taking into account the 5%. So what about the difference of 4.25%? It's not quite clear. This just says that Section 7C doesn't apply if that loan is subject to the provisions. Well, it is subject to the provisions, not fully, partly, it is subject to the provisions of Section 31. And so we would say that that loan is excluded from Section 7. But SARS is now indicating that they want the deemed donation under Section 7C, at least on the interest differential between your market-related interest rate and that SARS rate of 9.25%. So the possible amendment that would come through here would say where the loan advance or credit constitutes an affected transaction as defined, to the extent that it is subject to the provisions of Section 31, it would be excluded from Section 7, but then you've still got the exposure being the difference between the SARS rate and the market-related interest rate. All right, so yeah, we'll have to see what comes through in the draft legislation, but it looks as if that's how SARS wants to deal with this. Okay, so Louis has said, if you had that loan to the foreign trust and you wrote it off, what would be the impact on the resident taxpayer? So if you wrote off that loan, so you would have to say, as far as your resident taxpayer is concerned, you've got a capital loss basically on the loss of that loan. The foreign trust has got a gain, as it were. You would probably have to look at the provisions of Section 19, etc., and paragraph 12 of the 12A of the 8th schedule just to see, because it links to what was the loan actually used for, and as to whether it's going to trigger any tax outcome. So as always with tax, it does get a little more complicated than a simple off-the-cuff answer. So there could be tax implications, but it comes back to what the loan was originally used for and who's got a benefit on that loan. And for the resident individual who's suffering a capital loss on that loan, well, it's a loss related to a connected person, so you would have that loss would be clogged. You would not be able to set it off against other capital gains. All right, and then yeah, you're welcome. Thanks. All right, and then as far as your VAT amendments are concerned, you can see there's quite a number of them here. It looks like the VAT guys have been quite busy at SARS and National Treasury. I'll talk about some of them in individual detail, and the rest just to note that these changes are coming through. I won't list them all in the interests of time. The most important ones are the ones that I think will affect many of people who are on this webinar, are the ones that I will specifically talk to. So one of these relates to this national housing program, and it deals with low-cost housing. So what happens is that if you have a business that is constructing low-cost housing, and they would typically get a grant from the government to cover the cost of that low-cost housing. So that grant from the government is a deemed supply in terms of Section 823, and then Section 11(2)(s) provides a zero rating provision on that. So that's really nice for those construction businesses, because they get to claim their input tax credits, and it's a zero tax on the output side. And so they end up with the best possible VAT situation. But there seems to be a lot of confusion recently. That's all very well for the houses that are transferred, but many of them seem to be kept in a rental pool, all right, rental stock. And that's really where the confusion seems to come in. There have been certain sections that were on the table, but they haven't been implemented. And there's just a lot of confusion. And so they need to have clarity on the VAT treatments of payments relating to the rental stock. If it transpires, because if you think about it, the rental of residential accommodation is an exempt supply, okay? So if this becomes an exempt supply where the housing is held as rental stock, exempt as opposed to zero rated, that has a very negative VAT outcome, because then it means they can't claim the input tax as far as that is concerned, and it's going to result in a lot of additional cost to those construction companies. So yeah, it's going to be interesting to see what they actually put on the table. They propose that amendments will be made to clarify the VAT status, but that's all they've said. So we'll have to wait and see what's in the draft legislation. And then this one gets a little complex. If you think about a company with a local South African company, and then in the same group, there's an offshore subsidiary, all right? Now, if you look at the definition of resident, this offshore subsidiary, is that a resident or not? Well, the definition of resident in the VAT Act links to the definition in the Income Tax Act. And that talks, if you look at a company or a trust, it talks about where that entity is effectively managed, all right? So if you've got a subsidiary that's a non-resident subsidiary, it could be that it's effectively managed in South Africa, even though all of the business activities of that company are conducted outside South Africa. So let's call it Company A, Company B, right? Company A is a South African company. Company B is the offshore company, but regarded as a resident in terms of the definition of resident. Now, if Company A provides services to Company B, all right, it would look from a business case as if you were providing services to a non-resident, because Company B is carrying on the enterprise outside South Africa. They have no interface with the South African VAT system. But yet, because of the definition of resident, it's bringing that Company B into the net of being a resident, and therefore your services can't be zero rated. They're going to be subject to the standard rate, and yet Company B can never claim that VAT back. So the change that will come in here is that they want to amend the definition of resident to exclude that type of company, all right? Because if they're not included in the definition of resident, then they clearly are non-resident, then you've clearly got a supply of services to a non-resident that would be zero rated. On electronic services, so here we saw electronic services coming into the scope of the VAT Act a number of years ago. Foreign providers of electronic services to residents would have to register as vendors and charge VAT. And that would happen regardless of who they were providing that service to. All right, we're talking about residents, but we're talking about whether it's provided to a vendor or an end consumer. And now, after much discussion and a bit of experience, they've realized that actually this deemed supply should only be where you've got a supply to an end consumer, not business to business. So they're looking at cutting out the business to business supply, that would not be a deemed supply. And then as far as that supply is concerned, that non-resident supply would not be carrying on an enterprise, etc. And then the other aspect affecting your foreign suppliers electronic services relates to the appointment of a representative vendor. They want, up until now, they've been exempt from this obligation, but they want to have them appointing a representative vendor. But to take a practical approach to this, they're saying that representative doesn't necessarily have to be a resident. And furthermore, you don't have to open a South African bank account. All right, so they are waiving those requirements, but they do want a representative vendor to be appointed. Okay, and then this one I think is quite important for many of you. The prescription period for input tax claims. So currently, with a tax invoice, if you want to claim the input tax, you've just got a prescription period of 5 years. You've got to claim the input tax within 5 years from the date of the invoice. So if you had an invoice dated March 2023, you could potentially claim that input tax anytime up to February 2028, all right, in any of those tax periods, as long as you claim it within the 5 years. But now SARS wants to change that to say that you would have to claim the VAT in the tax period in which that invoice date falls. So if you get this invoice today, it's dated March 2023, and you realize we never claimed the VAT, you wouldn't be able to just claim it in this tax period. You'd have to go back and reopen the March 2023 tax period, claim the VAT, and then, of course, you're going to end up with a VAT refund, so no doubt a VAT audit, and so on. So they say here to ease the administrative burden. I'm not sure it's really going to ease the administrative burden. Okay, but that seems to be the way SARS is going to want to play it, so we'll have to wait and see when the draft legislation comes out to see exactly how that's going to work. Timing of VAT on imported services. So remember that in terms of Section 7, you have to pay VAT on the imported goods or services, any person. And if you import services, you have to pay VAT to the extent to which those imported services are not going to be used to make taxable supplies. But this payment of VAT, so any person, right, might have to pay for this VAT on the imported services. But the payment has to be within 30 days of the earlier of the receipt of the invoice or the time any payment is made towards that supply. And the observation has been that that is too restrictive. And so now they're saying, right, they could consider pushing that out to 60 days. So that's what we should see coming through in the draft legislation. And then on the tax administration side, there's 4 main amendments that they've announced. I'll talk about the ADR separately. They're also looking at reviewing temporary write-off provisions and removing the grace period to appoint a public officer. Just take notice of that, is that going forward, when you register a company for the first time with SIPC, you would have to actually appoint the public officer at the time of registration. That's what they're looking at here. No grace period to appoint the public officer. And then I'll talk separately about the Arena Holdings judgment. So let's just have a look at these two things, the ADR, and then I'll talk about Arena Holdings. So currently, if you have a dispute with SARS and you lodge an objection, if SARS disallows your objection, you then go on to the appeal process, right? And one way of resolving that dispute at the appeal stage is through the ADR, the Alternative Dispute Resolution Proceedings. And that process, even though it has attracted some criticism, that it has actually resulted in the resolution of a very high percentage of disputes between SARS and the taxpayer. And so it would seem that it actually streamlines and does away with many of the problems that might otherwise be found in the dispute resolution process. And so now they are looking at introducing another earlier ADR opportunity, and that would be after lodging your objection. All right, so you'll be able to lodge your objection and then through the ADR process, resolve the dispute at that point without having to wait to go on to appeal. And I guess they're hoping to take out many of the disputes at that point and resolve it through mediation, through the ADR process. All right, so look out for that one. Remember that these administration provisions, typically what would happen if they come through the draft bill, they get promulgated, they would be effective from the promulgation date. So if this does come in, it will come in either December 24 or January 25, depending on when this bill actually gets promulgated and signed into legislation. Okay, I've spoken about the grace period, and then Arena Holdings. Sorry, my text here seems to have shrunk, but anyway, I'll have to just lean closer to be able to read it. Some of you might remember this case of Arena Holdings last year. It was Arena Holdings being the company that owns Financial Mail, Business Day, and there were also some journalists, Abu Bungani and so on, that were involved with these others here. And basically, they had been trying to get hold of the tax records of our former president, Jacob Zuma. And that came about as a result of the book that was written called President's Keepers by Jacques Poe, where the author of that book had alleged that there was gross non-compliance that had never been properly investigated. And these journalists then went to try and get hold of the tax records so that they could see whether they could verify or discredit this claim that had been made about the non-compliance. But the SARS commissioner steadfastly refused to release the tax records. This party then took an application through the Promotion of Access to Information Act, because, of course, we have the Tax Administration Act that has the protection of taxpayer confidentiality. Promotion of Access Information Act allows access to personal information in certain circumstances, but in Section 35 and 46, there's a blanket prohibition that you cannot access a person's tax records. And that's borne out through the Tax Administration Act, which also says under no circumstances can you access tax records. And so this party brought this, they were successful at the High Court, and they went through to the Constitutional Court for a confirmation of the High Court order that these sections were actually unconstitutional and needed to be amended. And the Constitutional Court confirmed that, and they said they were unconstitutional and that they must be amended within 2 years, within 24 months of the court order. But in the meantime, the Constitutional Court said, we will hand down what the wording should be. In the meantime, this must be read into the legislation. And that would be that to allow information where disclosure of the record would reveal evidence of either a substantial contravention of or failure to comply with the law, or an imminent and serious public safety or environmental risk. And together with that, the public interest in the disclosure of the record clearly outweighs the harm contemplated in the provision. Now, the harm is the sort of piercing of the person's protection of their privacy, right? The invasion of privacy, in other words. That's the possible harm. But if the public interest clearly outweighs the harm, it could justify the disclosure of a person's tax record in those circumstances. But notice here, the disclosure must reveal evidence of a substantial contravention or failure to comply with the law. All right, so the Constitutional Court was basically saying that in limited circumstances, taxpayer records should be able to be accessed. Well, I understand that they tried again, went back to SARS after this judgment and asked again for the records, and SARS still said no. But now in this Annex C, they have said that they will have to look at bringing this amendment into the legislation. I mean, typically, legally, this amendment already has effect because the Constitutional Court said we're going to put this kind of lead-in wording in the meantime. But by the end of May 2025, we have to have an amendment made to the legislation along these lines. It doesn't necessarily mean that we will automatically see all of our major politicians' tax affairs in the newspaper, because obviously there would be a very strong legal fight in both directions. And this could go on for years before anything comes out of it. But in principle, the point is that in these circumstances, we should be able to access a person's tax records. I wouldn't just say, well, this is great, because obviously, put yourself into that situation. Would you like your tax records to be in the public arena? But on the other hand, we do have certain expectations about people in public office. And that's the whole point about the public interest in the disclosure must outweigh the harm contemplated. So I think that this wording is carefully considered. It kind of draws on the wording that's already there for other types of personal information, but obviously with very strict application as far as tax records are concerned. Okay, so I think that does bring me into the end. Does anybody have any questions that you would like to raise at this point, or have you all gone off to go and find some water somewhere? All right. Yeah, pleasure. Thank you for your thanks. And I'm glad you enjoyed it, Audrey. It's been wonderful to be here. So I'm going to then just say thank you to everybody for being here. And I'm going to hand back to Stan. Thanks very much. It's been a pleasure presenting to you this afternoon. All the best to all of you. Goodbye.
Yes, thanks, Jackie.
Thanks, Jackie. Very interesting afternoon. If anybody has questions now, I don't know if there are any. Maybe Jackie will answer them. Otherwise, you can address the questions to Danny and he'll forward them on to Jackie.
Yeah.
Okay, the only question that remains is whether there's a possibility to fix the economy in some way, but I don't know, jury's out on that one. And thank you very much, Jackie, for, as I say, your input, which is really staggering. And thanks everybody for attending, and we'll see you next time. There are a number of webinars, seminars coming up. We're busy working with various presenters. Jackie's still going to honor us with her presence over the next year, so you will be seeing more of her. You will be getting your certificates within the next day or so, and I wish you a wonderful afternoon. I didn't know there was no water, but I've got water, so I don't know.
I'm glad. Don't say that too loudly, Stan.
Well, I got half water, half air.
Oh,
I think I heard Carte Blanche was doing it as an article, how actually that Rand Water is charging people for air instead of for water.
Oh gosh.
Because
the
meter still runs actually with the air.
But it's
So
air.
it's fizzy water. So sparkling.
Well, you can always go to Stan. He's got water.
Yeah.
Do a calculation of what it would cost you if you bought water for your swimming pool in a bottle as opposed to the municipality providing it.
Oh, gee. And?
Well, the calculation is about somewhere around 10,000 for your pool. And if you buy it in bottled form, about R1.5 million.
Yeah.
Before we get too carried away, I do see a question from Colin right at the bottom, Jackie.
Yeah. Yes, I see that. So this was this latest round that I spoke about, where Rita went back to SARS and said, right, now can we have the information? And then SARS says it's lost some of the information. Well, that's very concerning. If that is indeed the case, I don't know. But I think it's also a little bit of sort of buying time, perhaps. But, they're not easily going to make that information available. So the parties are going to have to fight for it. But I mean, how it can be lost, I don't know. I shudder to think. I hope that's not the case. Okay. Yeah.
All right. All right. Thank you,
Okay, we'll
everyone.
leave it at that. Thanks very much.
Thank you. Thanks, everybody.
See you
Bye-bye.
Have a
again.
good day. Bye.
Bye. Thank
Yes,
you.
bye.
Bye.